All right, afternoon, everybody. Give it a moment or so here to let everybody jump in. Hopefully you can see me. I'm here with Larry and Rich in the conference room, back in the office. Pretty exciting times, change of scenery here. All right, everybody. So we're going to go ahead and get started. Just like last week, we're going to talk a little bit about innovative solution focus, which is our core value of the month here at DLP. And our focus is that we don't simply talk about problems. We put ourselves in positions to create solutions and produce previously unthought about results for our clients. We've been challenged to do that quite a bit here these past few months. I'm excited to report here again this week on some of our results. And this week, we're going to follow a similar format. We're going to talk a little bit about some of the questions that have come in here. Again, this past week, we're going to open it up to questions that you have live here today. So you can type those in the chat box as we move along, and we'll open it up to live questions here here towards the end. But this week, we realized, we kept getting a lot of questions. And frankly, I know I've been finding myself, and I know Larry and Rich have, spending a lot of time outside of these webinars. People asking, can you walk us through, the housing fund? Can you walk us through the new, note fund that you guys have? And realize, despite we've been communicating with everybody here each week, we've done a pretty poor job of explaining the actual investment vehicles. We spent a lot of time explaining what we're doing and how we operate. We haven't spent a lot of time talking about the funds themselves. And we've actually done quite a bit of change this year from the fund options that were available just a few months ago. So we're going to dive into that a bit here today as well. So with that said, I'm going to dive in to some of the questions that have come in here this week. So first one, you've mentioned April was a better month than you expected through the virus. How is DLP performing at this point through May? Yeah, so it's been pretty darn exciting here in May. So, thinking back to end of March, we were in a situation where so many, people were worried and predicting that nobody was going to pay their rent, nobody was going to make their mortgage payments. And then I think the whole, kind of country was shocked, overall with how well rent collections were. We ended up at 94.5% rent collections. And then, but everybody said, oh, well, if April was a good month, and, we were proud to say none of our borrowers went into default in April and everybody made their payments. And everybody said, well, we're not out of any risk yet. May is going to be much worse. May is when everybody's not going to make their payments. So in May, we put the same kind of level of focus and attention to our collections and both our borrower payments and our rent payments. And I'm proud to say through the 10th of May, we've actually collected over 5% more rent collected than we were at this point through April. So end of April, or at April 11th, we had 18% of our rent not yet collected. So we had collected 82% of our rent. Here so far this month, we're now at 89% through the same period of time. So significantly, tremendously better than where we were at April, when we ended up with 5.5% of our rent not collected, collecting 94.5% of our rent. And then when it comes to our borrower payments, we ended up April collecting all of our borrower payments, having no new defaults. And here in May, we're down to just 2 borrowers who haven't yet made their May payments, and in a great position to end up again collecting all of our borrower interest payments here for the month of May. So things have gone very well. Not to mention, of course, we're sitting here talking to you from our conference room. We're back in here in the office here in St. Augustine, in our Orlando, Florida office, in our Holly Hill, Daytona Beach office, and then hopefully in just a few weeks in our Bethlehem headquarters. So a lot of optimism through the real estate industry, through real estate markets. For those of you living in places that aren't yet reopened, it's amazing to see how quickly people have come back to going to restaurants, being out, being active again. Where a lot of people thought that might take some time. It's been been tremendous, and the amount of excitement that we're seeing and feeling. So it's definitely been a very exciting past week across the board. All right, so next question. What's the biggest challenge you're still facing in the lending and multifamily strategy right now? So I think the biggest challenge we're still facing is still, uncertainty. Nobody knows exactly how this will last. Nobody knows if there's going to be another lockdown situation. Nobody knows, how long standing the economic ramifications are going to be from these past couple months of shutdown. Nobody knows how long the government's going to continue to, and I don't say this in any negative way, a lot of the government interference has been very positive on the short term, but nobody knows how long the government's going to continue to interfere with the kind of natural markets. The biggest day-to-day challenge that we're dealing with related to that is the CARES Act related to evictions. So right now, the way it's being interpreted, which is still a little bit open, but the way it's being interpreted right now is you cannot evict any resident for non-payment through August as a national rule. And then certain states have extended that out even further already, such as New York. So that's the biggest challenge. We're very fortunate that despite the inability to evict, we don't have a lot of residents not paying their rents. But that's still going to be a challenge that we're going to have to deal with in the next few months for sure. All right, so next here, now that businesses are reopening, how is your strategy changing going forward? So I think one of the great things in seeing businesses reopen, I think a lot of people who've sort of been closing their eyes and waiting to see what happens sort of are now finally starting to take some action. And we're seeing, activity in terms of more kind of the distressed opportunities now starting to show their head. Even though some people have been struggling here for the past 2 months, now starting to come up and communicate and look for opportunities, look for cash. Starting to see sellers, real estate operators we've been in communication with who we expected would be struggling, starting to now want to talk about sale. So we're starting to see some of the distress that's going to come out of this come forward. So we're heavily, kind of like we're doing with you guys here as investors, we're heavily focused on communicating with operators and borrowers and potential sellers so that when they are ready to take action, that we're hopefully first in mind. And we're starting to see opportunities. We're starting to put out offers on properties now over the last couple of weeks, starting to have a lot of opportunities we're starting to get offers out on. So we're really starting to see what we expected, a few weeks back would start to happen, that there's going to be some great opportunities for us to jump on here and expect a very big third and fourth quarter. All right. Have loan applications volume and new rentals slowed during the virus? And if so, have you had greater impacts based on geography? So I think we're getting a disproportionate, effect. I think there's no doubt that less people are renting apartments or houses over the past 2 months. Less people are looking for loans, et cetera, right now. But I think we're getting a disproportionate amount of the business, just like there's probably less investors out there looking to allocate capital over these past couple months. I think because we're staying out in front of people, because we're staying open, because we're continuing to innovate and find ways to do business, because we do have capital, we're still out there lending. We're getting a lot of the business that our competitors are not able to take advantage of, either by choice or by circumstance. So such as on the rental side, a lot of communities, a lot of our competitors basically stopped operating. They stopped leasing. They stopped showing apartments. They just kind of froze. So that created a great advantage for us. So our leasing activity has been tremendous. I mean, when we moved in a net over 200 more residents than have moved out, we've had incredibly low move outs and incredible great amount of move-ins over this past 30 days. And we've continued to see that over this past week. We're at our highest portfolio occupancy ever right now. And expect that to continue here over the next month for sure. We continue to have record-breaking loan application volumes week after week. So the activity, the volume of we look at, kind of lead measures, the front end activity, people touring our apartments, new leads coming in, people applying or inquiring about loans, all the initial steps to the process that then leads to revenue and closings have been, really, really, really strong. So in short, in terms of how this is affecting us, we're remaining very focused on residential real estate, both in terms of direct real estate backed lending, as well as the acquisition, construction, improvement, and management of rental communities, both multifamily and single family, of course, predominantly multifamily communities. We continue to stay focused on growing our vertically integrated operations. We continue to hire, we continue to grow our teams, we continue to focus on building out processes, technology, planning for growth. We continue to stay focused, of course, on zero principal losses to our investors. Our reporting will be out tomorrow for our monthly lending fund reporting. And I'm excited to say that lending fund is the only fund currently reporting its returns on a monthly basis. Soon the housing fund here is about to be doing so as well. But we generated 11.42% net return to investors in the month of April here in lending fund, continuing to be very consistent returns, continuing to exceed our target returns. In fact, as many of you know, we did lower our target return in lending fund, income and growth fund to 10% from 11%. Yet again, in April, we exceeded 11%, which we're excited about for sure. So on our private lending side, I'm going to touch briefly on this. I'm going to walk through the specific funds and what's available today, which has changed here this year, the fund options we have available. So right now we're very focused on mitigating risk. Risk mitigation has always been at the center of our strategy. One of the reasons I can say why we're having no new defaults and why we're performing so well is our attention to risk. The fact that we have great diversification in loans, great diversification in geography, great diversification in borrowers. The fact that we lend to experienced borrowers who most cases been around a while, have done a lot of deals, have been through multiple cycles, lending to borrowers who are used to buying distressed assets in volatile times. An example of types of deals and types of borrowers we lend to. So this here is a property in Chicago. Borrower's company's name is called Valley Renovations. And this was really, at the end of the day, this is on the lower tier of our borrowers, meaning this is a borrower on the low end of experience. This was a $78,000 loan to acquire and renovate this home on the south side of Chicago. At the time of funding this loan, the borrower had done 7 deals. That's on the low end of our experience level. So to mitigate that risk, we really focused on helping this borrower focus on properties with lighter renovations because the borrower didn't have as much experience doing heavy renovations. And then we also made sure we put in place 10 months of interest payment reserves, meaning the borrower had to come up with a lot more cash. And we made sure that we had the reserves in place to cover loan payments. And we did so for 10 months in case it took them longer to complete this project. So you'll see here, they came in, took this little home, renovated there with a facelift to the kitchen, new granite counters, refinished the floors, put in stainless steel appliances, new vanity. They did a real nice job. But this was a light renovation, $20,000 or so renovation. So our loan was $78,000. It was a 60% loan to value based on the value we put on it when we funded it. And they ended up selling it for $147,000. So our loan ended up being closer to 50% loan to value of the actual completed value. And they sold this in under 8 months, 2 months less than the interest reserves we set up. So that's an example of very typical type of property, very typical type of borrower, but actually on the lower experience level, but typical type of loan and renovation that we fund every day. Here's another example. This was in St. Petersburg, Florida. A-Frame West Coast LLC is the entity. This is a borrower we've done a lot of loans with, a line of credit borrower. This was a $189,000 loan for the purchase and renovation of this property, a great market in St. Pete, Florida. They'd done many deals with us. They came in there and took this home that looks like essentially a mobile home, but it is actually a block property. Came in and renovated the whole exterior, renovated the whole interior. So it was a $189,000 loan. It was valued at 70% loan to value. That's on the very high end of loan to value that we do. We've done a lot of loans with this borrower. And so they fully renovated. They sold it for $294,900. So our loan ended up being more like 64% loan to value. And they sold it in less than 6 months. So that's, again, another very typical example of a type of loan we fund. So in addition to us funding loans to borrowers, we're continuing to very much stay focused on buying ourselves as an operator, continue to focus on finding ways to extract value, to be very conservative what's going to happen in the market, to focus on buying deals that generate double-digit cash flow, focusing on strong cap rates, and being, again, very conservative to what's going to happen with rent growth, what's going to happen with vacancy, what's going to happen with expenses and inflation. We go through a heavy due diligence process, underwriting hundreds of deals every month, even through this COVID time, putting out 5 to 20 offers. It's been even less through this COVID time, with an expectation and a historical track record of getting 1 or 2 deals a month through our due diligence process to closing. This is, again, we talked about this one last week, but this is our most recent acquisition, right outside of Charleston, West Virginia, 340 apartments, paid $43 million for Class A, nearly brand new. That's a pretty great price right now. To build a community like this would be about $175,000 to $180,000 an apartment. We paid about a third less than that for a community built in 2008 and 2016 in great condition, with a value add strategy of really just driving great management, improving the amenities, and driving up the quality of the 2008 units to match the 2016 units. Great resident base. Actually, through COVID, our biggest problem at this property has been that so many people are buying their own homes to capitalize on low interest rates. So it just gives you an idea of the quality of our resident base, that the only reason they're leaving is to buy a new home. But we've had very low delinquency, and the property's been performing very solid through our first few months of ownership. This is another community we bought here right before COVID, Willow Trace in Shreveport, Louisiana, being rebranded right now as Prosper. And I'm going to draw a blank on it right now. It's going to hit me, but it's a much better name than Willow Trace. It'll hit me in a second. And built in 1978. It actually abuts a golf course, well-maintained community, 2 pools. We're coming here again, driving management, driving up some a little bit better rents, some exterior improvements, and we'll drive up our yields there, generating great cash flow. Again, one of our lower communities in terms of delinquency, and we've been performing great through our first few months. So if you're looking at our lending side of our business and looking at our real estate ownership side of our business, as the different ways that we invest, there's a few ways you can invest with us. In order to get an allocation into everything we do here at DLP, you can do so through the DLP Housing Fund. This is our new flagship $1 billion fund that opened the beginning of this year. It's an evergreen fund, meaning it'll be open indefinitely, just like all of our other existing current funds, like the lending fund and income and growth fund. It's a hybrid fund, meaning it does debt and equity, and it's a REIT. That's a tax election. That has nothing to do with what you see on the stock market. It's just a tax election to help make the fund more tax efficient. In this fund, again, we do lending and we own real estate in this one fund structure, giving us the ability to invest in everything DLP does, helps us maximize utilization of our cash, minimize the time it takes us to deploy capital, helps us to be able to navigate, to generate, to invest in whatever is going to give us the best risk-adjusted return, such as here right now in Q2. Largely, our investments are lending right now in Q3. Come the end of this year, we'll be very focused, especially in Q4. I think will be a very big quarter for us for acquisitions, but we'll be able to navigate based on where the opportunities are to generate the best risk-adjusted return. This will be and is now our hybrid fund. This will very quickly be our largest fund. Currently, the fund owns over $200 million in real estate, over 4,000 apartments already. Right now, the fund is 100% real estate ownership, but over this year, we'll gain allocations into our lending strategy as well. Gets all the tax shelter benefits of owning real estate, largest benefit being depreciation, which shelters the majority of the gain from tax. And the other really, really big benefit of this fund versus our previous equity funds. In our previous equity funds, as we sold properties, we then had to take those gains, long-term capital gains, which is still very tax efficient, but we had to take those gains. We had to realize those gains. Here in this fund, because it's evergreen, because we're going to stay open, when we have large gains on selling properties, we're going to be able to reinvest those gains into additional acquisitions in 1031-like tax exchanges, continuing to defer out our taxable gains versus having to realize those gains at the investor level. So really, really tax efficient strategy. We pay out monthly distributions now. We're going out each and every month here now moving forward. We reevaluate the portfolio every year, and we'll then pay out EDC, excess distributable cash, returns above our monthly distributions at the end of each year. You can redeem out of this fund each year as well. So annual redemptions. You don't have to make a 5-year, 8-year, 10-year commitment like in a typical real estate equity fund. So here's the quick highlights on one slide. It has a 6% monthly distribution. That's an annualized return. So in other words, we distribute out to you a 0.5% dividend each month. You invest $1 million, you're going to get a dividend every month of $5,000. That dividend gets paid out before we even earn a management fee. After we pay out your 6% preferred return every month, after then we receive our management fee. It's an 80-20 split, 80 to you, 20 to us. And then to incentivize us and really continue to align our interests. We want to take away the risk of you not getting your 6% return, because we don't get to earn any management fee till you earn a 6% return, including if there was ever a loss. We'd have to cover your loss and get you to 6% return before we can earn $1. But then once we've done that, once we've hit your preferred return and got you to over a 12% target net to you, then we get to earn 40% of the total profits and you earn 60%, further incentivizing us to exceed our return target of 12%. This is going to be, again, our largest fund, $1 billion fund. We will invest a minimum of 5% of all the committed capital. Right now, we have more than 20% of the capital as the capital in this fund. We have here, as meaning myself and the GP here at DLP, and very likely will end up with a significant, sizable investment, much larger than 5% of the committed capital. But just shows that our line, I'm not going out there and buying properties with my money elsewhere and then giving the rest of the deals to the fund. Properties we invest in are the properties that the fund invests in together in the same deals. We are audited through Cohen Resnick, and our legal counsel is Stuart Kissel, and we report out on this fund in terms of fund level on a quarterly basis. So those are the high levels to this fund. Our largest fund, or what's sort of been our flagship fund over the last number of years, has been our lending fund. This fund has generated now 5+ years, our 6th year, generating double-digit annual returns net to investors, and also provides monthly distributions, has a very high preferred return target of 10 or hurdle of 10%. We have 90-day redemptions, and I can say now, which I think is pretty amazing, that through this COVID time even, we will have redeemed out any redemption requests in under 90 days, even through COVID, which is, really shows the power of the redemption and liquidity to this fund. So this fund, again, it's on 6 years, got great diversification. We've now funded, actually, this slide says 1,200 or 1,500 loans. This fund does not get the benefits of depreciation like the housing fund. The housing fund is definitely the most tax efficient fund, but it does get the benefit of what's called qualified business income deduction, or which is 199A in the tax code, which means whatever your tax bracket is, you get a 20% reduction. So if you're at the 37% bracket, you'd be taxed at 29% instead of 37%. Of course, if you invest in this fund through qualified money, through an IRA or a 401k, you can shelter all the gains from tax through a qualified account. And this fund is a REIT as well. So this fund makes first position loans backed by real estate, 10% preferred return to investors, 10% before we even earn our management fee that's paid out on the first of each month. And then after we calculate our returns for the month, such as the month of April, which was 11.42% net to investors, then that additional 1.42% gets paid out around the middle of the month, what we call EDC. So you actually get 2 distributions a month. In this fund, like all of our funds, you can reinvest those distributions instead of taking them and have them reinvest on a monthly basis as well. And then after we exceed, again, the 10% preferred returns, 80% to you, 20% to us of the profits above that 10% hurdle. So that's the lending fund. This is the historical performance here. This dark blue is the 10% preferred return. This middle blue is the 11% historical target. And then this jagged line is what the actual returns have been. And the big point here is the target's been 11 for all this time, and we've drastically exceeded it over that entire period of time. You can see our annualized returns reported on a monthly basis here each and every month. And I apologize, I was saying 11.42. I was confusing March and April. It was 11.39 for the month of April, so 11.22 for March. And we actually went up in April to 11.39% while maintaining more cash, while maintaining lower leverage. So inherently reducing the risk, we still maintained 11.39% this past month. This gives you some overview to the fund, the diversification. We land in 34 states. We actively have loans out in 20 some states right now, but with a big allocation to Pennsylvania, as you expect, as that's where our company is headquartered, where we have lots of relationships, a lot of knowledge. Secondarily, Florida, where we're talking to you from right now, of course, again, because that's where our Southeast headquarters, and we have a lot of knowledge and relationships. Georgia, right across the border here, New Jersey, right across the border from PA. Those always make up our top 4 states, or historically always have, because of the states we have our largest physical presence, knowledge, relationships. We have staffs and offices and team members in all those states. You can see it here broken down by geography. You can see it broken down here by type of asset and by overall loan performance. And then the newest fund we have available is the DLP Positive Note Funds. This fund just officially went live last couple weeks. So this fund is new in that it's a brand new fund, but it's not new in compared to what it's done here. And DLP investors have experienced the same investment vehicle for a long time. So I'll describe what I mean there. So this is our newest fixed return fund option. We're offering 5 to 10% fixed returns to investors. Investors can commit for as little as just 90 days. Investors have the option of taking monthly distributions or letting it compound monthly. Investors can invest via qualified or IRA funds or non-qualified. This is our first ever Reg A fund. That's an SEC regulated fund. Really, I think to most that really doesn't mean a lot, but I can tell you that, to larger institutions, again, such as a pension fund, that's meaningful because it creates another level of oversight and review of our financials and our reporting and our performance and our execution to our strategy. We provide audited financials and semi-annual financial reporting to the SEC. And this is open to non-accredited investors with certain criteria and limitations for non-accredited investors. So before I'll show you the actual rate sheet in a second, but the other tie-in and how this fund sort of came to be in terms of its name as the DLP Positive Note Fund is this fund led us down a path that's actually merged and I say has changed a little bit since we initially set out for this path over a year ago. And the original plan was that we were going to donate part of our management fee for this Positive Note Fund to our Positive Returns Foundation. This is a foundation we set up a couple years ago with a focus on tackling a couple really big epidemics in America. The epidemic of a major lack of affordable housing, an epidemic that's only going to be compounded through this COVID environment, in addition to the epidemic of a lack of jobs here in the US. And again, an epidemic, as we all are hearing, is only growing here through this COVID environment. So those are the two big focuses, and they really go hand in hand, of course, jobs and housing that we're really focused on. In fact, we actually had our quarterly meeting on our foundation just this morning and doing some pretty cool things. And when we set out and launched this foundation, what we said is we're going to donate part of our management fee of this note fund to the foundation. That's how we tied in this positive name. As we've been thinking about this and as this has developed and transpired, we've actually made a bigger commitment to the foundation. And what we've actually decided to do is that we're actually going to donate 0.25% of our annual management fee for all the capital we raise in all of our funds now. So that doesn't come from you, that comes from our management fee. So certainly if you invest and allocate more money to us, in effect, we're going to donate more money, but it comes out of our 1% management fee. So we're really excited about that. And then we also at DLP, we donate 0.25% of our net revenue, which is an actual larger part of our funding the foundation. And then third way we support this foundation directly is all of our team members are encouraged and we provide them with ability to take time off of work to donate 1% of their time to the foundation as well. So we'll be sharing more about this. We've actually had a great conversation today. We may launch our first gala event, similar to kind of our dinner gala events, but focused on the foundation in the near future. So more coming on this, but wanted to give this little tie-in here to the positive note funds. I know a number of our longstanding investors have been waiting for this fund because they wanted to be able to invest in a fund that had some great effect above and beyond generating good returns to you as an investor. And I can say now, not only will this fund do this, but all of our funds here for all of 2020 are donating here to the foundation. And some of the causes that we've already supported the foundation have been causes that some of our investors have been involved and passionate about and have brought to us as well. So pretty cool tie-in for sure. So this is the note rates. So this is the fixed note rate that you receive if you come into this fund. These are rates that are net to you. So this is the net yield that you earn fixed. And this is guaranteed by DLP. It's not guaranteed, of course, by the FDIC, but it's guaranteed by DLP, meaning we're obligated to pay you this return. This is the lowest risk profile of anything you can do with DLP, of course, hence our track record, hence our focus and our principles of no losses to investors. We don't expect and do not accept having losses to investors in any of our funds. But if you were going to look at the world falling apart, our note investors in short get paid first because they're debt. So it is the lowest risk profile. And as you can see here from the screen, based on how much you choose to invest and the duration you choose to commit, the rate ranges from 5 to 10%. That 90-day note option means you invest today, and at any point you can give us a 90-day redemption notice. It doesn't mean we just automatically redeem you in 90 days. It just means you can redeem out with 90-day notice, or you can commit for a fixed 1-year period, 3-year period, or 5-year period. And you'll know exactly how much you're going to earn. You know exactly what it'll be. You can take that distribution monthly or let it compound and grow and get a monthly compounded yield as well. So those are our funds that are available today. The only one I missed that's available today is the Income and Growth Fund. So of course, as I show this slide, which shows you that in Q1, we generated 11.78% net return to investor and lending fund. And then you see we generated a 13.11% in the Income and Growth Fund. You might want to say, well, what is that fund all about? It's very, very similar to lending fund, has a couple nuanced differences, including it does invest a good amount of its capital into properties in which DLP has some ownership in. So if you're interested in our lending strategy, we can talk to you about both of these funds. You can decide which one's a better fit for you. Then we have the option of investing in the DLP Housing Fund that we just talked about, which has a 6% annualized preferred return. And then we distribute out everything above that on an annual basis. So we're only reporting out on the 6% preferred return on a monthly basis. As we're calculating our EDC as of now annually, we may get to calculating that more frequently, but right now it's calculated annually. So certainly we are driving value in these properties. We're just not recognizing that on a monthly basis yet. We generated a 13.77% annualized return in the DLP Equity Fund 2, which is a fund that's very similar to the housing fund as it sits today, in that it's a fund that owns multifamily value add communities. And then we generated a 12.33% annualized net return in the DLP Fixed Fund, which is basically our first version of the lending fund, Income and Growth Fund, but it's not currently available to investors. It's an old legacy fund that we've managed for a lot of years, but very comparable returns to lending fund and Income and Growth Fund. And then of course our fixed rate note holders, like we just went over in the last slide, achieved whatever the fixed note rate they locked in at. They received that fixed return over the past quarter. So our focus remains great returns, no losses. And we've never had a year here at DLP where we have not grown as a company by at least 60%. We've never had a year here at DLP where we have not raised considerable amount more capital than we raised the year before. And we do not expect to change these slides here after COVID, after 2020. We will have another year of great growth. We'll have another year of great growth in terms of our funds, capital that our investors have deployed to us. And we look at our growth in size continues to add more diversification to our assets, more diversification reduces risk to our investors, allowing us to continue to generate great returns with no losses. So a couple last additional updates. I hit on some of this already, so I'll move very quick and open up to questions. May ran, as I said, significantly better than April. April, we ended up at about 94.5%. May, we are doing much better than April at this point in the month. May interest payments from our borrowers, we've already collected more than 95% of our borrower payments with an expectation of no new borrower defaults this month. On the acquisition side, probably won't end up closing on any new multifamily communities this quarter. It's possible, but probably not likely. But we are getting offers out. We are starting to do due diligence on deals, and we do expect to have a very strong second half of the year. Our team members, as we are talking right now, are back here in the office. If you hear some background noise around us, that's people alive and here at the office on the phone doing work. You've been seeing people maybe walk by our conference room here. So we have most of the team here. It's been really cool to see. Most people have been anxiously wanting to get back to the office. We made it an option for our team members if they couldn't work from the office or didn't want to. You know, they were at high risk. They, have childcare challenges. You name it. We didn't require it, but most people have immediately came back to the office and anxious to do so and get back to being with fellow team members. It's been awesome. Hopefully Bethlehem will be turned to phase yellow in Pennsylvania soon, as I know the team there is chomping the bits to get back. And of course, we're following all the precautions of social distancing and so forth. All right, so a couple of things to fill you in on here for the first time today. So June 18th, a few weeks from today, will be our first ever real estate investment roundtable and happy hour event. I should say, I and a few of the DLP team members and a few top real estate investors for sure will be in Asheville, North Carolina, hosting this event. We are hopeful we'll be able to have it as a live happy hour event for our Asheville investor base, or any of you who want to have a reason to come to beautiful Asheville, North Carolina, an amazing time when it's going to be in the 70s and cool and beautiful, and spend some time with us there. But then we will also be streaming this roundtable discussion live, just like we did our virtual dinner, just like this. And we'll be doing it at this exact same time. So it'll be from 4 to 6 that Thursday. So you'll just be able to jump on this same login if you're not joining us live in Asheville. And if you're joining us live in Asheville, information on that location and details will be out soon. So it'll be a live and virtual event. So really excited about that. And then right at the tail of that, which is one of the reasons that'll make this roundtable pretty cool, is as of now, we're expecting to have some of the top real estate operators in the country come join us in Asheville. We did this same weekend last year, and they'll be coming to join us on a 2 to 3 day full mastermind event. So I'm going to be bringing some of those top real estate minds and operators into our roundtable discussion with all of you on the 18th at the beginning of our mastermind group that we do with top operators, helping them, grow their businesses, helping them execute, helping teach, and help them grow their businesses. And then on July 17th will be what is scheduled to be our quarterly big investor event that we normally do in Bethlehem, that we did via our virtual dinner on April 30th. Our next event will be July 17th. We will absolutely be doing this as a virtual event, just like the April 30th dinner, but very hopeful we'll also be doing this live. We will also definitely be live in Bethlehem, but hopefully we'll be able to have a ArtsQuest event center filled with many of you, while also streaming it live to those who can't join us live. So we'll definitely be doing it no matter what on July 17th, no matter how many we can have live with us. Will be coming out here soon, as we're all waiting to find that out. And then, of course, you can also reach out to any of us individually for more insights, specific questions as well. So with that said, the mic is open per se for you to type in questions into the chat box. I know many have been doing as I've been chatting, and Larry or Rich are going to ask those questions out. We don't have to do this via Zoom with each other. We get to do it right here in the conference room together. So here we go.
Thanks, Don. Yeah, so lots of fantastic questions coming in already. The number one question we've gotten so far here was in terms of how we are utilizing the funds with lending in the housing fund. Right now, of course, we have equity only in the housing fund, but does the housing fund then invest alongside the lending fund, for instance? Or do we have different lending criteria, and how do we manage that process?
Yeah, it's a great question. So in general, the first answer is there's no significant different lending criteria. So a loan that works for the lending fund, as an example, will work for the housing fund and vice versa. So we're not lending the housing fund, higher risk loans or lower risk loans. It's the same underwriting process. In terms of our lending team, who's doing the underwriting, who's mitigating the risk, they don't know as they underwrite the deal if it's going to lending fund or income or growth fund, housing fund. It makes no difference to them, and we don't have to do any difference or diversification or have to choose based on risk profiles which fund it goes to. What's going to determine which fund it goes to is going to be pretty simple. It's capital deployment. So we're going to do our best effort possible to manage the deployment across our funds, manage the cash sitting in those funds to maximize yields. So the housing fund actually, though, ends up benefiting all funds, because since the housing fund has the ability to do lending or do direct acquisitions, it's going to help the housing fund be better at cash flow management, which then in turn will really help the rest of the funds as well. And then we're also working aggressively right now on closing new borrower base warehouse facilities, which we should have a new one closed here this month, or should we refreshed one of our facilities this month and then opening a new one in June. And how these borrower based leverage facilities work is we can pledge a loan to that facility, and then we don't take the money though till we need it. So it helps us manage and deploy our cash so we can get your money deployed faster and easier, and we have loan payoffs, we can pay down our debt and keep our money deployed and so forth. So between the housing fund and these warehouse facilities, it's really going to help us even better manage our cash, which is our day-to-day biggest challenge with hitting yields. But at the end of the day, we're going to manage that based on which funds have cash sitting, use our best efforts to deploy capital accordingly based on how long investors are waiting for for subscriptions for deployment.
Excellent. So real quick, Wally, you're getting some questions online as well as through social media. There are questions around leverage. So one is, how much leverage do you use in the fund? And then the other is, if you're using minimal leverage, how do you expect to continue to hit the returns that you're hitting?
Yeah, so thank you, Rich. So when it comes to the real estate side of our business, so meaning where we own the real estate, we are on average, when we initially take out the debt, on average, we're around 65% leverage. For most real estate, quote unquote, real estate guys will tell you that's low leverage for new debt on a new acquisition. Across our actual real estate portfolio, because we're coming in and we're putting money into these properties, we're increasing the value through better management, through capital deployment, we end up with mid-50s actual leverage on our real estate portfolio. We have 54, 55% leverage on our real estate portfolio. So again, by I think almost any real estate guy standards, that would be low leverage. Interesting enough, and it's partly, I guess you could say, design, partly it just ends up working out coincidentally. The average of our leverage, meaning what we lend to against real estate where we're the lender, ends up being historically 54, 55%, meaning our loans. If the lending fund makes a loan, on average, we're making a loan for 54, 55% of the value of that real estate. But the actual question, I believe, was how much leverage do we borrow against our money in the lending fund? So let me illustrate it here, maybe in an example. So let's say all of the real estate we have loans against is $100. Just to pick a number, you could say it's $100 or $100,000, but just you say $100 just for simple numbers. That means we would have loans of about $54, $55 against that $100 in real estate. So real estate's worth $100. We lend those borrowers $54, $55. That's your money. That's the lending fund's money. So we lent out $54, $55 against this $100 in real estate, or maybe for more real life numbers, we lend out 54, 55 million against $100 million worth of real estate. So out of the fund's $55 million worth of capital that we lend out against that $100 million worth of real estate, right now today, about 15 million of that would be leverage from a bank, and 40 million out of the 55 million would be the investor equity, your capital, our capital as investors. So real estate's worth 100 million. The borrower and the value the borrower created is 45 million. They're at the top of the capital stack. Then our fund has 40 million of equity, and then the banks gave us 15 million. That would be how it works out today. That's been pretty close to where it's been over the last couple of years. In fact, we've never been higher than having $1 of leverage to $2 of equity, meaning we borrowed $1 for every $2 of our equity we have. I've been telling investors every year for 6 years now that we will increase our leverage, and that I expect will be closer to $1 of leverage for $1 of equity. And I still feel that that's where we will end up, and steadily we will get there. We've never have to this point, and we've hit the yields that we showed you just a few minutes ago with the kind of leverage ratios we've always been at. And just to give you a little reference point here, one of the reasons that we're still lending and we're growing through this is the fact that we've been low on leverage. So a lot of our competitors, or the people who were our competitors 2 months ago, had 90, 95% leverage. Meaning in that example I gave you of our average competitor would be, if the real estate was worth 100 million, they would lend 70 million. And out of that 70 million, 65 million would be leverage and 5 million would be investor equity. And that's why when their leverage cut them off, they couldn't lend anymore. And that was the case for a lot of our competitors. So being at even 50% leverage is very conservative use of leverage by most people's standards.
Awesome. So with that said, I think along those same lines there, talking about performance then of the funds, we saw that sometimes the income growth fund performs better, sometimes the lending fund. What's your outlook on performance in those funds, and certainly within the housing fund going forward then?
So out of the three equity vehicles we have, the housing fund, the lending fund, and the income and growth fund, 110% expect the housing fund to generate the highest returns. It has the highest return target by 2%. And I really think overall, the actual underlying investments have much higher targets. So lending fund, the targets we generate, the yields we generate, we're never going to shock you in the lending fund hit 15% next month. It just can't happen. The way we make our loans, the way the portfolio is set up, we can't earn anything more than the interest rates we lock in at, plus a little bit for default interest or late fees. But really the income is kind of limited to what we can ultimately earn. On our real estate equity side, we've been selling assets over this past 18 months where we've been getting 50, 60, 70, 80, 100% annual returns. So we can drastically exceed, the 12% return target. So the housing fund, I absolutely expect, will generate the highest return. But the difference, so let's just say the housing fund hit its target of 12, and it didn't hit anything more. And let's say the lending fund and income and growth fund, let's say, even to be a little bit more on the optimistic side from right now, let's say they hit the historical return of 11. And again, both funds have historically hit higher than that, but let's just use that as an example. Let's say we increased the target back to 11%. If the lending fund hit 11% and the housing fund hit 12%, it's not an equal comparison, because lending fund 11%, unless you're investing qualified money, you're going to pay about 29% tax for many of us on that. In the housing fund, most of the income is not going to be taxed. So the net tax difference on the funds will very likely end up being many percent, but it'll certainly end up being, very likely 3 or 4% annual return difference. And if we hit the kind of returns that we could hit in the housing fund, it could end up being net of tax 7, 8, 9% difference in yield to investors. So housing fund we expect to be the highest return. Out of the lending fund and income and growth fund, over the last 4 years since we started the income and growth fund, I told investors the same thing for 3 or 4 years. I always told investors, I can't predict. They both have the same target. I'm not going to guarantee you anything, but I've always said I expect with time the income and growth fund will outperform the lending fund. And for the first, year and a half, as the income and growth fund just got up and going, it was smaller and it was harder to manage cash. I was wrong. And for the first year and a half or so, lending fund generally slightly outperformed the income and growth fund. Over the last year and a half, that is reversed. Last quarter, it was significantly higher. Income and growth fund outperformed lending fund by 1.5%. So I'll tell everybody the same thing I've been saying for a long period. They both have the same target. I'm not going to, don't hold me to it. They both have the same target. I'm very confident both will exceed their target. If I had to project out, I would project the income and growth fund will slightly outperform the lending fund moving forward.
And Don, how, in terms of the length of our loans, right, and the fact that we have loans paying off all the time, new loans going out all the time, especially with April being our highest submission month ever, how does that work versus holding longer term paper like other institutions do, and how does that benefit our investors?
Yeah, so our average loans, pay off in single family side, they pay off in less than 9 months. The multifamily, if you include the multifamily side, it becomes 9 to 10 months. Most of the loans we originate are at 6 months. So the vast majority of our loans pay off in less than a year. Versus even most other bridge lenders, a lot of bridge lenders out there are 3-year bridge loans, 5-year bridge loans. And doing longer term loans is way easier for us. Think about it. We got to do all the work to underwrite a borrower, underwrite a property, get it appraised, manage it actively, to only have it pay off and only collect income on it for a few months. Versus, doing a 30-year mortgage, right, where I get to sit back and collect payments every month for 360 months for at least 5-10 years. It's a lot more work doing short-term loans. But there's big benefits to doing short-term loans. First big benefit is we're not locking in to long-term real estate risk, I'll call it, meaning, and I don't in any way, shape, or form expect this here right now, but if there was a major decline in real estate values, we're not sitting there saying, all right, today we're 55% loan to value, but next year we're 65, and next year we're 75 because property values are dropping. We're not taking that downward risk in any significant way because our loans are, on average, a loan on our book is going to be paid off in 4 or 5 months from today. So that's we don't take any long-term real estate risk in our loans. The second big benefit is we can get higher returns. Nobody's going to pay 10, 11, 12% interest rates for a 5-year loan or 10-year loan, but they're willing to do it on a very short-term loan because they're not looking at a long-term interest payment cost. They're looking at it as a cost of the deal. And then the third really big benefit is the liquidity it provides to our investors. So if I was a lender making 5-year mortgages, 10-year mortgages, I could tell you I have 90-day redemption period. I could tell you we're really liquid, but I'm reliant on people paying off their loans, or I'm reliant on new capital coming in. I don't have any natural form of liquidity. For us, we don't need $1 of new capital to come in for us to be highly liquid because our loans are paying off. 1/3 of our portfolio pays off every quarter, every 90 days within every redemption period. So for us, being able to honor redemptions is something that we've always been able to do, and that's a big part of it because we have loans literally at our size today. Almost every day we have loans paying off.
Yeah, and another big benefit, right, is we're not taking long-term interest rate risk, which is huge.
Yeah, that's a great point.
It's very short. But along those lines, we're getting some more questions here with respect to the actual deployment. It's something people bring up all the time. We've got several questions that are asking just around, again, how long does it take to deploy funds in each of the different funds?
Yeah, my first comment I would tell you is anytime you'd be thinking about making an investment with us, check in with us at that point in terms of what we estimate for deployment. We can never tell you exact because we don't know. We have to sit in this position here as a fund manager and be responsible and do what's best. Be fair per se to you as an incoming investor and to our existing investors. So meaning if we can't use your money today, I can't deploy it today because that hurts the returns for everybody else in the fund. So I can't deploy your money until I have a deal to put your money into, and we're not going to ever take undue risk to deploy money faster. So, historically, if we look at the past 6 years of lending fund, it's taken us 15 to 20 days. Historically, looking at the income and growth fund, it's taken us 10 to 15 days. Historically, in our equity funds, it's taken us about a month. So, but any given time, based on how much money has come in ahead of you, based on where we're at in our deal volume, it can vary. It's been extremely rare for it to take us more than 60 days to fully deploy money. Compared to, we hear all the time, I hear all the time from investors who invest in different funds, and they're waiting 6 months, a year for capital deployment. So, and we can do, like in the housing fund is a good place. We've built in a capital call provision. So you come and say, hey, Don, I want to invest $1 million in the housing fund. And we tell you, look, right now we don't have anything closing in the next 60 days. It could be 90, 120 days. Well, you can sign up everything. Will you hold your place in deployment? And then we'll give you 15-day notice when we're ready to deploy. And then, we call that money then. So we can always do that if we think it's going to take some time. And if you have some place you can get a great return on in the meantime, that might make sense for you. But at any given time, we can give you an idea. We can tell you, example, today, I could tell you, hey, right now it's going to take longer to be deployed in the lending fund than any other fund because we have a lot of money that's come in the last 30 days that's in process of deployment. We have way more money in the lending fund sitting waiting for deployment than the housing fund, income and growth fund combined. So right now, if it was today, I would probably say, hey, income and growth fund, we're probably going to have you deployed in 15 to 30 days confidently. Housing fund probably going to have you deployed in 15 to 30 days. Lending fund maybe is going to be closer to 60 days today. Again, don't hold me to those exact numbers. You come and tell us the amount of money, amount of time, we can give you a little bit better. But those are, rough idea off the top of my head without looking at anything that I would say if somebody was talking to us today. So we can give you that kind of dialogue. And if you say, well, I still want to go on lending fund, that's the fund for me. We can always say, great, either lock in now, sign your docs, and we'll capital call you when we're ready. Or, you can deploy and just be a little patient. That it might take you 36 days doesn't mean it couldn't happen faster, and doesn't also mean we might not deploy you in chunks depending on the size of your investment.
And we also have the option for notes as well in the interim
Yep.
while they're waiting to be deployed. So
Exactly.
great.
So turning over to the multifamily side for a minute, in terms of our acquisition process, and we have just a couple more minutes left, but Bob had asked, do you set and track occupancy rates and debt coverage ratios when we, assess an asset? And how do we track those after we purchase? So can you just talk a little bit more about the acquisition process as it pertains to those things, as well as ongoing asset management?
Yeah, that's a great question. So yeah, absolutely. I mean, when we buy an asset, we're looking at all the historical occupancies, historical NOIs, historical delinquency. That can be a little harder to determine at times, depending on the operator's books. We're looking at the most trailing 12 months. We're analyzing performance on the past 12 months, past 3 months, past month. We're looking for trends. We're analyzing leases. We're looking at the quality of the residents. So we do a lot before we buy it. And then before we buy it, before we own it, before we have our actual hands on it, we have to make some assumptions then based on a lot of due diligence, a lot of work we do to what we're going to be able to perform our first year of ownership. The first 90 days to 6 months is always the hardest to predict because owners can, especially in distressed situations, they can play games with things that you can't tell until you kind of get in there. In terms of games they'll play with not claiming people are delinquent on rent and things like that when they are. So, the beginning can always be a little bit difficult, which we try to be conservative in what the first few months will look like as we get our hands on the property. And then we lay out projections for the whole first year, the second year, the third year, the fourth year, fifth year. And one of the things that we pride ourselves on, and one of the advantages, I think, of being in a fund structure is nobody is, you're not investing in one individual deal. You're not investing in one exact business plan that has to stick to this exact strategy. If we went out there to big institutions, a big Wall Street firm, and they invest in a deal with us, and we give them the projections on that deal to what our value add strategy is going to be, what our performance is going to be, they're so rigid and so structured that we have to stick to that exact plan. And sometimes those plans turn out to not make sense. And I'll give you a real life example here. Let's say, we buy a property and we say, all right, we got to spend $5,000 to upgrade these apartments. If we spend this $5,000, we're going to get $100 in additional rent. It's a good strategy. We're getting a good return on it. So we go down that path. But we get in there and we realize, well, if we just manage this property really well, we don't have to spend $5,000 and we can spend nothing and get $75. Well, if I can get nothing and get my rents up $75, it makes better sense not to spend the $5,000. So we may get into a property and then deviate, or we may, on the other side, we may go into a property and say, hey, our business plan is to renovate a third of the units in the initial business plan, and we think we're going to get $100 a month in rent. Well, we get in there and realize we can get $150 in additional rent. So we're going to say, well, we're going to go in there and do more. And we may take that phase further to increase our yields. We may get in there, we may have made assumptions to think, hey, granite counters are going to be really valuable in this market, and turn out the market really wants something else different. What's a bigger driver in this market for some reason is adding washer dryer hookups in the units. So, we're constantly testing and tweaking and adjusting our strategy to make sure we're always doing what's going to generate the best overall yield. And that flexibility of having a fund structure that gives us that flexibility to do this, to do what's best for the overall return, has been a big part of why our yields have often been very outsized, is because we're adjusting in real time to the opportunities in front of us. And then in terms of our tracking of that to investors, so us internally, I mean, we run 80 different metrics that we report on a daily basis, and we produce out reporting on a weekly basis that we're managing here internally and monitoring. And we're monitoring not only our current performance, we're monitoring what does end of month look like across all these metrics. We're monitoring a 6-week forecast. We're monitoring budget through the end of the year. So we're doing a lot to monitor and forecast. And you'll see here if you look at the housing fund reporting, which we're excited about, some of the improvements we're making and how we report on this new flagship fund. You'll be able to see our performance at acquisition, our performance current, our rating on if we're performing above, under, or at, our targeted performance on that asset, and some overall commentary. And then every deal we buy, we produce a detailed investment summary, so the investment thesis and the overview and the demographics and the strategy and the plan. We produce that and provide those out to the investors on the housing fund as well. And then the ongoing reporting we provide on each asset on a quarterly basis is kind of matched up against the original business strategy, but that strategy, I said, may tweak and develop as we get into that asset.
Awesome. Well, I think that's time for today. If you have any final thoughts, Tom.
Awesome. Thanks, everybody. So to wrap up here, appreciate all the questions that came in today, that come in between. If you have any requests to a specific topic or any specific area of content that you think would be valuable to you, or some of you long-term DLP veterans that you think could be valuable to others, we welcome ideas to continue to make these weekly events different and unique and bring value to many of you spending a full hour of your week with us every week. So we really appreciate that. So we'll take any insight. We will be mixing these up in a few weeks with that June real estate roundtable, which you'll be hearing more about, which I'm pretty excited about. And we'll continue to change up the format. So these are meant to educate and provide insight and overview. So any way we can do that, bring value to you, please share with us. I appreciate everybody's time here this week.